Hello friends, welcome to CEC Live Lectures. Dear friends, today in this session we are going to continue further in our series on financial accounting. Friends, in this session we are going to talk on one of the important topics while we study financial accounting, and this topic is consolidated financial statements. Friends, first we are going to talk on the important terminologies used in this regard, as well as later on we are going to discuss on how to calculate goodwill. And for the discussion on the topic, we have with us in our studios Dr. Amarjeet Kaur. Dr. Amarjeet Kaur is a professor of accounting, and she is teaching in one of the leading institutions of the country. And we would like to tell you all that she is a prolific, a dynamic professor who believes in giving her best to the students. She is a certified management accountant from USA, and she has authored numerous books on accounting. Her books are admired by the students as well as academicians worldwide. We know that while listening to her lectures, you always feel to get answers to your questions. So friends, you have privilege to ask questions through her, through our toll-free number. Please note down our toll-free number. Our number is 1800110430. I repeat, our number is 1800110430. You are just requested to call in the last 10 minutes of the lecture so that you could first have a deep insight into today's session. And yes, of course, in the last 10 minutes, we promise to give answers to your questions through Dr. Amarjeet Kaur. Now, I would like to welcome our guest, Dr. Amarjeet Kaur, once again. Hello, ma'am. Welcome to the session.
Hello, Geetika. Thank you very much. Very good morning to viewers, and welcome on this lecture on consolidated financial statements. We shall be talking about a basic terminology in the first half, and then we will have few examples to understand goodwill and structure of financial statements when consolidated. So friends, we are sitting in a era where globalization is the need of the hour. No business can do without actually shaking hands with others. It has become very, very important that we do financial engineering, we do corporate engineering, we shake hands with the other players within the country, with players from abroad, overseas, and then actually bring out the best, either in terms of product, in terms of practices, in terms of the final outcome of any service we are rendering. So whatever we are into, whatever kind of business we are into, the best results are expected when a business concentrates on its core functions, and actually for other things it shakes hands with other businesses, right? So subsidiary or secondary functions are basically handed over to others, either by outsourcing or by some other means. In this process, of corporate restructuring, a very common trend which has emerged in the last few decades or couple of years is this, that mergers and acquisitions are taking place worldwide. I may not say all of them are or have been successful, but yes, they have been happening across the world. Of course, agenda is same, the motive is same for everyone, that they want to earn higher profits, they want to have better results of operations. So keeping this fact in mind, we are seeing that now businesses are running not in one entity as a single entity. The businesses are being run as one entity having many other entities as subsidiaries, as associates, and then the question comes in, if we have such situation in the background, in the industry, then how to deal with when it comes to accounting, right? So accounting becomes very, very important under such situation, and then we cannot apply simple accounting which we do for a single entity in case businesses are run in consolidation, are run in more than joining hand with other entities. In such cases, the kind of or the set of financial statements which are needed are known as consolidated financial statements. I hope you could understand the background. So keeping this in mind, now the next question is, what is consolidation? So consolidation is when a business through the ownership of other companies tries to control the ownership of other companies and runs the business. So this is what is known as consolidation. So an entity would have control of a subsidiary and will usually prepare financial statements for itself as a separate entity, and would also require to prepare financial statements which are in consolidation. I hope you are understanding the point. The point I am making is this, that when a company is having subsidiaries, I will explain you later in few minutes what subsidiaries are, because these are the technical terms and have very specific meaning in accounting. So what I am saying is now is this, that a company which is having business run with the help of subsidiaries is required to prepare its own financial statements, and those financial statements would be known as financial statements of separate entity. Along with that, a company would need financial statements in consolidation, right? So accounting standards, they require that the company, which is the investing company, which has invested in shares of other company, should show the investment at cost, right? So this is what is required. All right. So the point is, this should be understood very well, that when do we need to prepare consolidated financial statements. So I will repeat, under a situation when a company invests in shares of other company acquires certain share, a certain percentage of share, which we will discuss very soon, of some other business, and that business becomes subsidiary of the company. In that case, consolidated financial statements are required, right? Now this controlling interest, I am saying when a business controls assets of other business, right? Now this controlling interest may result into the control of assets of a very different value to the cost of investment. What does it mean? Something very, very interesting. Let's say there is a company named X, right? It acquires shares, 60% shares of another company named Y, right? So what will happen? So Y becomes subsidiary of the company X, and X would be known as parent company. Now the next question is, the shares which have been acquired, the assets for which a company has right is 60%. Those assets were actually of the cost of say 12,000 crores, right? So the cost of assets acquired is 12,000 crores, whereas the company has paid 14,000 crores. Now company would be, so the cost to the company would be 14,000, I mean cost to the parent company, to the investing company. So the cost to the investing company is 14,000 crores, right? Whereas the value of assets acquired is 12,000 crores. Now company would be showing 14,000 as an investment in its books if I am preparing books of single entity. But fact could be something different. The fact is that the assets which I have acquired is of only 12,000. The remainder, the excess amount of 2,000 crore is basically the goodwill amount being paid by the acquiring company, by the investing company. So this fact will never be known to the shareholders of parent company if they will just look at the investment, because in the balance sheet or financial statement of the parent company, the only value which would be shown is this, that 14,000 has been invested in Y, whereas fact is the assets which we have acquired are only of 12,000. We have paid 2,000 more, which is over and above the value of assets acquired, right? So that is another reason that group accounts are needed, so that a fair, a true information is being provided to the stakeholders either in X or in Y company, right? So to reflect the substance of investment, and the substance of investment is what? The substance of the investment is this, that the value of assets acquired is 12,000, it is not 14,000. So now, as per the revised accounting standards, we are paying much more attention to substance, to the rule of substance, than the actuals, right? So keeping this fact in mind, this is another reason that we need now consolidation. Okay. Now let's take have a look at this example. A very small example is in front of you. Kindly have a look at this slide. This slide shows you two companies. Please have a look at the slide, and the slide is showing you two companies, one parent and another is subsidiary. I have purposefully named them as parent company and subsidiary company, and that's what we generally use. P stands for parent and S stands for subsidiary in discussions whenever I refer to these two words. So the first line says investment 80% of subsidiaries, so we are showing 600. Other net assets, and the liability, so 400 and 700. So other assets, that is assets less liabilities given for the company, is 400 for parent company and 700 for subsidiary company. So the company, we have acquired 80% of the assets, which means 80% of 700 means it should be 560. How much is investment shown in S? It is 600, right? So the value of assets acquired is actually 560, whereas we are showing it as 600 in our books. So point is, it is then followed by share capital 500 and 250, retained earnings 500 and 450. So total of liabilities is 1000, total of assets is 1000 for parent company, and total of liabilities is 700, and total of asset is 700 for subsidiary company. So the investment of 600 in P's account is in subsidiary, right? The cost of owning only 80% of S net assets, which was 80% of 700, which is actually 560. So the remainder, which is over and above 560, we have paid as goodwill. So this could never be known to the shareholders of parent company unless this particular information is being shared by preparing consolidated financial statements, where we are showing the P's and S values for assets, liabilities, reserves, and every item which is important, right? So this is how it's very important to prepare consolidated financial statements for a business. Now we shall be talking about important terminology. I shall be talking about few terms which are used specifically, categorically when we are preparing financial statements, right? So the consolidated financial statements, what is consolidated financial statement for the purpose of consolidation? That is the first thing. The financial statement of a group of entities, when we present it together, as single entity and the parent entity, is known as consolidated financial statement. So the financial statements of group of entities, and group of entities means what? Group of entity means a parent as and subsidiary together, as I showed you on the last slide, right? So that's what is consolidated financial statements. The second term which I am using, and you would have heard it many times by this time, is group. So what is group? Group is basically a parent and its subsidiaries, When I am using the word subsidiaries, it means there could be more than one subsidiary to a business, right? If we took an example that X is parent and Y is subsidiary, there could be another company named Z which could be subsidiary, right? There could be another company, say L, which is a subsidiary. So, the point here I am making is this, that a group may comprise one parent and more than one subsidiaries. We may have any number of subsidiaries. There is no ban on the number of subsidiaries a parent can have. It all depends upon the size and the scale of the business, right? The next thing is subsidiary. What is a subsidiary company? I have used this word for many times and I need to explain it for the purpose of ease. So, an entity which is controlled by another entity known as parent is subsidiary, right? So, there are two entities, one entity is being controlled and another entity is controlling, having the right to control. So, here subsidiary is the entity which has been controlled by other, whereas the parent, if I talk about the next term parent is an entity which has one or more subsidiary and has controlling right, right? So, parent company or parent as an entity is having controlling right over subsidiary or subsidiaries, and subsidiary is an entity which is controlled by another entity known as parent. I hope you could understand these four terms which I introduced. Number 1, what are consolidated financial statement? Number 2, what is group? A group is parent and subsidiary together. Number 3, I said subsidiary, and number 4 I said is a parent company. Now let's go further and talk about what is control. I will talk about control in detail after a few minutes, but I am just introducing this term for the sake of basic understanding. Control over an investee arises when an investor is exposed or has right to variable returns. So, the slide is in front of you, it is showing in red, has right to variable returns, right, from its involvement with investee and has the ability to affect those returns through its power over the investee. So, this is very important. It means the control is a situation, is a power basically, and that power gives right to the parent company to influence variable returns. Variable returns means operating earnings, operating revenue. When we intend to earn profits, of course we may end up incurring losses, but we are always intending to earn profits. So, the point is when a company which is a parent company has enough power to influence the variable returns and ability to affect the returns to the power over the investee especially, is known as situation of control, right? So, control, we shall be spending more time on control after a few minutes. The next thing is which I would be using in my future lecture as well, the next term, which is non-controlling interest. Now, what is non-controlling interest? So, in the example we took that company has, let's take another example rather. A company has invested in a shares of a company, and the company which is where the investment has been made, the company name is Pickrick, let's say. So, Pickrick is the name of the company where investment has been made by the parent company, you may call it as X. So, X invested in Pickrick. The total share capital of Pickrick is of 1000 crore, right, and X has acquired only 80% shares. So, 80% share means 800 crores, right. So, remaining 200 crores worth of shares are with someone else. This could be some other company, this could be retail investors in more than one number, right, but the total value of 200 crores is with someone else. So, that particular value of equity, in this example it is 200 crore, would be known as non-controlling interest. So, it means 800 crore worth shares are under control of a parent company named X in this example, would be known as controlling interest, and remaining 200 crore worth of share or equity would be known as non-controlling interest, to which we generally call as NCI. So, which in short we call it as NCI, non-controlling interest, right. Then there is another word which is very important to understand for the purpose of differentiation between control and non-control and otherwise too, is trade investment. So, what is trade investment? So, trade investment, an investment in another company which does not give control, right, which does not give controlling right or significant influence. So, when can this happen? Let us say in this example we took that X has invested in Pickrick for 800 crores of equity, and remaining 200 crores of equity is with Y. So, investee company is Pickrick. Who made the investment? 800 crore X and 200 by Y. So, X is here the parent company because it has ownership of 80% of the shares, and Y do have ownership of 20% of shares, and here it would be known as trade investment by Y. This is basically not requiring any consolidation for Y. Y need not to make any consolidated financial statement because it is not very significant. So, we will call it as only trade investment. So, trade investment can be made for any percentage, generally less than 20%. I am using the word usually or generally, right, not very strict rule for trade investment, it could exceed 20%, but generally trade investments are of shorter percentage, less than 20%, 2%, 5%, 10% up to 20% generally is easily assumed to be a trade investment, and this does not give any controlling right to the investor, to the investing company. All right. Now, let us go to one important thing, that what is control. So, control, if I refer to Indian accounting standard and I refer to IFRS, both IFRS and Indian accounting standards, they have used a word power to define control, right. This power word is important. A slide is there in front of you. It is showing you clearly this power word in brackets and in red color. I want to put emphasize on this word because unless you understand what is control, you cannot think of deciding to consolidate or not. So, as a student of accounting or as just someone who is interested to learn about consolidation, it is imperative to understand that when is the situation of control, right. So, I would say, so both international financial reporting standards and Ind AS, they have used the term power to consider whether an investor is a parent having control over the subsidiary or not. So, this word power has been used. Control can be achieved by a number of ways, and the most easy and the important way which we look at, and in most of the exam papers you will find this is the only term which is used, and that number one is that holding more than 50% of the voting rights or holding more than 50% of equity share. So, if a company has 51% shares of other company, it would be known as the company is having control, company has power to influence variable returns. The second situation could be that controlling has appointments to and removal from the board of directors. So, you have controlling right either to appoint or to remove board of directors. Even in that situation you would be known as having controlling right. The third situation, when a company has majority of votes to cast in board meetings. So, companies they or carry their general board meetings, and if there is an investor who has majority of votes to cast when the meetings are going on, then that particular situation would be known as power of control or having power. Another situation could be that when there is a legal right to govern the financial and operating policy of investee. Investee means subsidiary, of course. So, if a business has legal right, somebody has been given some legal right by intervention of government or some financial institution. So, some legal right is been given to govern both financial as well as operating policies of investee. So, if a business has powers to decide financial policies as well as operating policy of the investee, that situation would be known as control. So, these are the basic terms to understand consolidated financial statements. I hope you were able to gather some idea. This is an important topic, a bit difficult of course, because it is not taught in all the subjects. This is a kind of advanced accounting. So, I hope you were able to gather the idea about consolidated financial statements. Thank you very much for being with us for these 30 minutes. Thank you.
With this note, thank you, ma'am. Thank you so very much for giving us a productive session too. We believe that, dear friends, that you have gathered maximum knowledge through this session and you are wondering for the next session too. So be with us as we are back after a short break and we are going to give you more and more of knowledge. Thank you for watching us.
Thank you.
Hello friends, welcome back to this session. Friends, as you know that today we are talking on consolidated financial statements, and for the discussion of the topic we have with us in our studios Dr. Amarjeet Kaur. Dr. Amarjeet Kaur is a professor of accounting and Through her, we always get in-depth knowledge on various topics. Friends, we believe that you always get resourceful content, and you have lots and lots of questions in mind too. Friends, if you wish to ask questions from Dr. Amarjeet Kaur on today's topic, then do call us through our toll-free number. Our number is 1-800-110-430. I repeat, our number is 1-800-110-430. Now, I would like to welcome our guest, Dr. Amarjeet Kaur, and would request her to continue further. Hello, ma'am. Welcome back to the session.
Thank you very much. Good afternoon, viewers. We shall be continuing with the topic Consolidated Financial Statements. In the first half today, I have introduced few important terms which we have, we would be using in this topic. I shall be now talking about, when is the situation when we feel like there's a consolidation or need for consolidation. There's a situation of group being there, but when actually it is not there. So we will talk about a situation of significant influence and exception to consolidation, followed by how to calculate goodwill and what is goodwill. So we will take few examples in that. So the term significant influence is equally important in consolidated financial statements. And when does it happen? When does it arise is a question to be answered. Significant influence is a situation when a business has power to participate in financial and operating policy, but without having control. So you have the right to participate, but you cannot actually exercise control. That particular situation is known as significant influence, right? So it is control achieved when entity has power over another entity. So that is control. But I am saying you do not have control, but you have power to participate only. You do not have power to control. So that particular situation would be known as significant influence. Now we need to distinct between the two. Distinct between control and significant influence is very, very important in determining how to account for an investment in another entity. Because in both the cases, either I have invested, in both the cases, either I have invested a small amount or a big amount. I am investor, right? So in both the cases, I have invested and I have some kind of power to influence by voting, in the decision making. So significant influence give rise to associates and not to subsidiaries. So two words are used, one is associates, another is subsidiaries. So consolidation doesn't require to merge the accounts of a parent company with associate. Consolidation requires to merge accounts of a parent company with that of subsidiaries, not of associates. So when only significant influence is there, but you do not have power to control your variable returns, that would be a situation of significant influence and not the situation of controlling, not the situation to consolidate your financial statements. So this was very important to understand. Now consolidated financial statements comprises what? A company which has a subsidiary at the end of its reporting period, that is a parent company, must prepare consolidated financial statements in addition to its separate financial statements. So we have accounting standards specifically for this purpose, and this is required by accounting standard. We have International Financial Reporting Standard number 10, which requires this, right? And along with that, its own statement of financial position with relevant notes. So company which has a subsidiary at the end of the reporting period, this point should be noted down. So it could be then when we begin the reporting period, we do not have a subsidiary. During the year, we acquired a company which became our subsidiary, right? After, let's say, after 6 months, after 7 months, we acquired a company, right? And we have that company being our subsidiary now, and it happened after 6 months of the financial year has been passed away. Nevertheless, that is not important. Then when did we acquire? Important is that on the last day, and when we are reporting for the period, we are preparing our financial statements, we do have some business which we are controlling and which comes under the definition of subsidiary. So we need to prepare consolidated financial statement for that company, right? And what we need to prepare? We need to prepare our own financial statements as independent company along with a consolidated financial statement. Now, consolidated version of its statement of financial position is required, consolidated statement of profit and loss account is required, consolidated comprehensive income and statement of cash flow is required, and all other relevant notes. Notes form an important part of financial statements, as we know, right? So those notes should be shown for the individual financial statements, all of them, either balance sheet or statement of income and loss, or your cash flow statement. For all kind of financial statements, we need to consolidate, including notes. So this is very, very important point to understand. Now I shall be talking about exception to consolidation. So when is there any situation when we need not to consolidate, though by definition we would have control? So is there any situation? This question needed to be answered. My answer is yes. There are exceptions when the situation may qualify as having the power to control. So situation is something which gives you a very fair idea that yes, the business has control over the company, but even then we need not to consolidate. Why? Because this falls under exception. And what is the exception? Some subsidiaries, the slide is in front of you, kindly concentrate on red colors. Some subsidiaries are not consolidated, and when does that happen? This occurs when control of the subsidiary is only of a temporary nature and the parent is actively looking to sell the subsidiary. Let us take some example. Let us say I acquired a business named say Delnet or Delphin. We can name it as Delphin. So Delphin has been acquired by my company, which is X. So X acquired Delphin, which is I acquired 60% shares of Delphin. So by definition, since I have acquired 60% shares, I have controlling right. I have power to influence the revenue or earned by the company, to influence the policies. I have the voting right. So I become parent company by definition, whatever we have discussed. So prima facie I have become a parent company. But if I am seriously looking, I do not intend to carry this business with me. I want to sell off those 60% share to someone else, and I am actively looking for some buyer who could buy those 60% shares of Delphin, which I have actually bought so far. In that case, I need not to consolidate, but important is the onus is on me. I need to establish in the eyes of law that I am actually looking for a buyer. I do not intend to continue with this investment. I intend to resell this investment to someone else, and I am looking for buyers who could buy those 60% shares which I acquired of Delphin, right? So this is an exception. This exception does not apply to subsidiaries acquired years ago. This point is very important. What does it mean? I acquired in this year, and I am practically I am keen to sell it off, and I am actually involved in finding out the buyer because I bought this company or those 60% share this year only. So in that case, I need not to consolidate because I acquired that 60% share of Delphin this year itself. But if the same thing has happened 3 years ago, I invested 60% shares of Delphin, but 3 years ago, and now today in this year I intend to sell it off and I am looking for buyers, then this exception will not apply. Then I need to consolidate. I have no choice than to make consolidated financial statements, right. So, I hope this point is clear, which is an exception to consolidation. Now, I would talk about an important thing, that is goodwill. How to calculate goodwill and what is goodwill. So, goodwill is a situation when we pay more than what is the value of assets acquired. So, X bought shares of Y, right, and the value to calculate the goodwill, because the market price of shares keep on changing, for the purpose of calculation of investment, goodwill, reserves and everything, we do not take market price of shares, rather we take assets as a kind of proxy to calculate goodwill and many more things. So, assets are taken as proxy to this in this situation. So, assets, let us say assets acquired are of X amount and you have paid Y amount. So, the difference of, if you have paid more, if Y is greater than X, X is my value of assets, Y is what you have actually paid. So, if Y is more than X, amount paid is more than the cost of assets, that difference would be known as goodwill, right. So, goodwill is basically when we pay over and above the value of the asset or the cost of fair value of the assets. Instead of value, I should be using the word fair value, right. So, if the fair value of the assets acquired of a subsidiary is less and you have paid more money, then this difference is basically goodwill. So, let us take this example to understand how do we calculate goodwill. Example is that when a company buys an interest in other entity, the acquirer will usually pay a price which reflects the net assets acquired and a share of goodwill. This is what we discussed. The amount of goodwill will be initially recognized in the consolidated financial statements of financial position and is calculated as below. So, this slide is coming in front of you. How do we calculate? The fair value of consideration. In this example, it is 500, right? And fair value of non-controlling interest is 200. So, non-controlling NCI, if you remember, we discussed what NCI is. So, the fair value of the consideration you paid is 500 and fair value of the non-controlling interest is 200. So, the value of the net assets which we acquired is 600. So, difference of this is 100. So, fair value of consideration paid plus fair value of non-controlling interest minus the fair value of assets acquired is basically your difference known as goodwill. If you acquired 100% of the shares of a company, then there is no question of NCI, non-controlling interest. This non-controlling interest would arise only when you have acquired less than 100%, 80%, 90%, 70%, 60%. So, the remainder 100% minus the percentage of shares acquired, which is say for example 60%, then your NCI would be 40%. If you acquired 70%, then the NCI would be 30%. If you acquired say 80%, the NCI would be 20%, right. So, whatever the amount of NCI that is going to be considered. So, fair value of non-controlling interest plus fair value of the consideration paid put together, and then we subtract the fair value of the assets acquired. The difference is your goodwill, which is to be shown in the books of accounts, right. So let's have a look at the slide, and you will get an idea, a broad idea, that how does we actually show consolidated financial statements. Please have a look at the slide. This is showing you net assets of P, which I have just denoted by the number by the letter X, plus your net assets of S. So both are consolidated together. So in this broad view overview, which is in front of you in this slide, it is clearly showing that net assets are added of X and Y together. So net assets of X and net assets of Y together are consolidated. Of course, certain adjustments are required, which we will be discussing in next in subsequent lecture. So we add item by item assets of parent company and assets of subsidiary company, and we show them together in consolidated financial statements. That's what is in the when it comes to assets part. When it comes to liabilities, the share capital of only P is showing. P means the parent company is showing in the consolidated financial statements, which means we do not show the share capital of subsidiary in consolidated financial statement. We show only share capital of parent company, right? Then the next important part would be reserves. Reserves are to be calculated after making certain adjustments. We need to take reserves of parent company and that much percentage of subsidiary company which are earned after acquiring, and to the extent of investment in percentage. Let's say reserves earned by the subsidiary company after acquisition are $100 or 100 crores. Out of those 100 crores, I cannot claim 100 crores in my consolidated financial statements unless I have 100% investment in my subsidiary. If I have 100% investment, then I am entitled to claim those additional reserves earned after consolidation in my consolidated financial statements. But if I have 80% right of control and 80% share in my subsidiary company, then I shall be adjusting those reserves. I shall be taking only 80% of the reserves. Remaining 20% goes to non-controlling interest people, right? So that is an NCI. So all these adjustments would be discussed later. I just wanted you to have an idea that assets are added line by line with few adjustments which we will discuss. Share capital only of parent company. Reserves are taken of subsidiary, and of course full value of reserves of parent company plus certain amount of subsidiary after making few adjustments which we will be discussing in subsequent lecture. Let's take this example. A parent has control of net assets of subsidiary 700 crores or $700 in crores you can take, or in thousands you can take any amount. So for the purpose of ease, I would say only 700 because it has a controlling interest, right? Now all net assets are consolidated, but the portion owned by other shareholder, which is 20%, is shown separately as non-controlling interest. So 140 would be shown separately. Assuming parent had just acquired its shares in subsidiary, it has paid 600 for net assets, right, of 560. So asset value 80% of 700 means 560, but we paid 600. So the difference of 40 is your goodwill. So this is a simple example to understand that how we should be taking this. Okay. So this is another example in front of you. This is showing consolidated statement of financial position. So the data which has been shown to you on the last slide, here I am showing you the solution. So goodwill is 40, right? And goodwill is 40. How did we get that? If you see, if you look at the slide, 600 was the amount being paid and 560 is the value of the assets acquired, 80% of 700. So which is 560. So the difference is 40, which is basically now coming out as goodwill and shown here in the consolidated financial statements. We are required to show amount of goodwill in consolidated financial statements after making the calculations as desired. This is the point number 1. The point number 2 is net assets would be shown of both the companies. So 400 plus 700. 400 is the value of assets of whose? Of the parent company. 700 is the value of assets of subsidiary company. So the total assets, as I said, assets would be added line by line. So total assets would be here 1100, right? So total of goodwill and total of assets of P and S put together in consolidated financial statements becomes 1140. So the asset side of my balance sheet in consolidated financial statement becomes 1140 in this small example. So now after that, what we have to take? We have to take share capital only of P, the parent company. The share capital of parent company in this example is 500, which we shall be taking. Then the retained earnings of P, the parent company, is 500, which we should be taking as it is. And then we have to take the non-controlling interest separately, 140. So retained earnings of both parent and subsidiary to the extent of share of parent would be added, would be shown under retained earnings, and the remaining would be shown as non-controlling interest separately, so that the users of financial statements have fair idea, fair information about the retained earnings. So we are supposed to show non-controlling interest share in our consolidated financial statement. Thus we have 3 items in this example. One is share capital 500, retained earnings 500 and non-controlling interest of 140. So the total becomes 1140, which is equivalent to assets. So assets were 1140 and so is the liability side 1140. So the total becomes same is matching. That's how a basic consolidated financial statement is prepared. So this was just giving you a small little idea. Now there are few things which are important. The rule, the substance is very, very important when it comes to preparing financial statements. So the rule of substance is important and is been shown to you here in front of you in the form of slide. The slide is clearly putting emphasis on certain statements marked in red. It says consolidation involves replacing the cost of investment in P's account with what it actually represents, and that is the net asset of subsidiary as at the end of the reporting period and amount of goodwill determined at the date of acquisition. What does it mean? If you have read the slide which was shown to you a few seconds ago, it clearly shows consolidated or consolidation involves replacing the cost of investment in P's account with what it actually represents. So we are not required to show the cost of investment as it is. We are required to show in part the net asset of the subsidiary at the end of the reporting period and the amount of goodwill determined at the date of acquisition in 2 parts. So it means if I have paid 1000 and in the example, if you take the example we referred few minutes ago, we made a payment of 600, right? Out of 600, 560 was the value of the assets. So we need to segregate 560 from 40 which is over and above, which is goodwill. So this is the rule of the substance requirement. So the rule of substance, rule of substance wants to show what is more substantial, what is more important. Here if we would show 600 together, the total is same, right? If we do not put goodwill separately, $40 or 40,000, then 560 of the investment made or the value of the assets acquired, it will not make a difference in total. The total remains 600. But what is important is that we want to emphasize on substance, and the substance is that my assets which I have acquired of subsidiary is of 560 only, not of 600, and the remainder which has been paid over and above the value of asset is $40 is actually my goodwill, right? So in this it's very important, same way the reserves of P must be created with P's shares of S post acquisition reserves. Again, this is an important rule of substance, that whatever has been acquired, by P as a parent company, and whatever the reserves, there is an increase in reserve that goes up after acquisition, only in that particular value of reserves a parent company has some share. Whatever has been acquired as reserves, has been accumulated as reserves before acquisition, is not important to be shown in consolidation. So we do not pay importance to that. So this substance rule is very, very important and actually needed to be paid attention. So I hope you were able to understand certain terms which we have discussed today, which we shall be talking in future as well when we are actually preparing consolidated financial statements. Along with that, I hope you could understand how to calculate goodwill. By this, I will conclude today's lecture. Thank you very much for being with me for this 1 hour. Thank you.
And we would like to thank our guest, Dr. Amarjeet Kaur, once again for giving us in-depth knowledge on today's topic. Friends, we believe that your feedbacks, your questions are important for us. Do write to us at info.cec@nic.in. This is the ID where you can put in your thoughts, and we'll try to take your thoughts, your questions next time when Dr. Amarjeet Kaur visits our studio. Dear friends, do write to us at info.cec@nic.in. And yes, of course, you can watch the lectures the number of times you wanted, as we upload these lectures on YouTube for you. All the lectures pertaining to the series are there for you on the YouTube channel. So keep watching us, keep writing us. We are taking your leave with the promise that we are going to meet soon. Thank you, ma'am. Thank you once again.
Thank you, Geetika.